Welcome to The Explainer. Today we're jumping right into a question that's on every investor's mind. How do you actually succeed in the stock market? We're going to break down the exact system the world's greatest investors use into 5 super clear, actionable rules. The goal? To help you stop guessing and start investing with real confidence. For so many people, the market just feels like pure chaos, right? It's this place where your portfolio's value is swinging all over the place, up one day, way down the next. And that volatility, it just creates this powerful emotional pull, leading us to make these knee-jerk decisions based on a scary headline or a gut feeling instead of, a solid plan.
And yeah, that emotional roller coaster leads directly to the single biggest trap in all of investing. When the market is flying high, greed just takes over, and everybody piles in, buying right at the peak. And then, when it crashes, fear grips them, and they sell everything at the bottom just to make the pain stop. This whole cycle is an absolute portfolio killer. But here's the thing. The greatest investors have shown us there's a much, much better way.
Now listen, this isn't just some clever saying you see on a poster. It's a complete philosophy. The legends, they don't rely on gut feelings or hot tips from their neighbor. They operate with a disciplined, rule-based system. It's basically a checklist that forces them to be rational when everyone else is freaking out, and it guides every single decision they make.
So in this explainer, we're going to break that entire system down into 5 clear rules. This is the framework that can totally transform your approach and help you make smart, informed decisions for the long haul.
All right, our first rule. This is the absolute foundation of the whole system. The idea, which Warren Buffett made famous, isn't about being the smartest person in the room. Nope. It's about being intellectually honest with yourself and just sticking to what you genuinely understand.
It's called the circle of competence, and it's this beautifully simple concept. Look, you don't need to be an expert on biotech and semiconductors and global shipping all at once. The whole point is to know the boundaries of your own knowledge and then, and this is the important part, stay strictly inside them. The future's always going to be uncertain, so you have to think in probabilities, and you can only really do that well in an area you get.
This right here is the core mindset shift you have to make. You are not buying a little ticker symbol that wiggles around on a screen. You are buying a piece of an actual real-world business. And that means you need to focus on companies with stable, predictable earnings, businesses where you can reasonably forecast their future because you actually understand how they make money.
So knowing the difference is just crucial. Think about a company like Procter & Gamble. They make Charmin toilet paper. There's not a lot of technological risk there, right? We've pretty much figured out the whole toilet paper thing. Now, compare that to a high-tech company, say Sirius Satellite Radio. They are totally vulnerable to a competitor like Apple coming out with a new gadget or service, like the iPod or podcasts, that can just completely blow up their business model overnight. One of those is way easier to predict than the other.
Okay, so once you've found a business you totally get, the next question is, can it defend itself? This brings us straight to rule number 2, finding a business with a wide, sustainable competitive advantage. Buffett calls this an economic moat, and it's the key, the absolute key to a company's ability to earn high returns for decades. Just think about it. A wide moat filled with alligators protects a castle from attack, while a powerful competitive advantage does the exact same thing for a company's profits. It keeps competitors from eating them away.
So, what do these moats look like in the real world? Well, it could be an incredibly strong brand like Coca-Cola, right? People will ask for it by name even if the generic stuff is cheaper. It could be a cost advantage like Costco, which can sell things for less than pretty much anyone else. Or it could be high switching costs, like the software your whole company uses. It would be a massive pain to switch to a competitor. These are the things that let a company just thrive year after year.
All right, so now we have a business we understand, and it's got a strong moat protecting it. The next piece of the puzzle is making sure it's being run by the right people and that it's a dominant player in its field.
There's an old saying that just nails this strategy. The first man gets the oyster, the second gets the shell. Successful investors don't want to own the 5th best company in an industry and just hope it catches up. No way. They aim to own the number 1 or number 2 player in a strong industry, the companies that are already winning the game.
So what exactly are we looking for? Well, we want market leaders that are growing faster than their competition. But just as important, we need smart, high-grade management steering the ship. And one of the best signs of that? When the top executives own a ton of the company's stock themselves. It means they've got real skin in the game and their interests are perfectly aligned with yours.
Okay, this next rule is absolutely critical. You could find the greatest, most dominant, best-run company in the entire world
and it can still be a terrible investment if you pay too much for it.
This is the idea of the margin of safety, a principle that Buffett's mentor, the great Benjamin Graham, championed. You should think of it as your ultimate safety net. It's your buffer against bad luck, against your own mistakes in calculation, and all the crazy, unpredictable stuff that can happen in the world. It's all about the gap between what a business is truly worth and the price you actually pay.
Let's break this down. It's so simple. Price is what you pay. Value is what you get. Your goal always is to get way more value than the price you're paying. A great example is when Buffett bought See's Candy. He analyzed the business and figured it was worth a lot more than the $25 million asking price. That big difference? That was his margin of safety.
So you follow this simple process every single time. First, you do the homework to figure out what you think the business is actually worth, its intrinsic value. You look at cash flows, earnings, all that good stuff. Second, you check the market price, simple enough. And third, and this is the key, you only pull the trigger when that price gives you a significant discount to your calculated value. It's that simple and it's that disciplined.
And now we've arrived at our final rule, the one that really underpins all the others. And in many ways, it's the most important one of all. It's not about how to make money. It's about how to preserve the money you already have.
You know, people often think Buffett is kind of joking when he says this, but he's not. He is dead serious. This is the absolute core of a successful long-term strategy. The best investors on the planet are completely obsessed with avoiding losses because they understand the brutal, unforgiving math of losing money.
And this is where that math gets so brutal. Think about this. If your portfolio drops by 50%, you don't just need a 50% gain to get back to where you started. Nope, you have to double your money. That's a 100% gain just to get back to even. That makes avoiding those huge catastrophic losses absolutely critical for your long-term success. So how do you put this into practice? You need a system with hard and fast rules for selling. Look, the goal isn't to be right every single time. That's impossible. The goal is to make sure your wins are bigger than your losses. A lot of successful investors have a non-negotiable rule. They automatically sell any stock that drops 7 to 8% below what they paid for it. No emotion, no second guessing, no, oh, it'll come back. This simple rule prevents a small mistake from turning into a portfolio-destroying disaster. And that's really the key. These 5 rules, they're not a buffet where you can pick your favorites. They are a single, interconnected framework. Every rule must be satisfied before you even think about putting your money to work.
And this is the true power of having a system like this. When you have a rule-based process, a bad investment isn't a personal failure anymore. It's a failure of the system. It just becomes a data point. It lets you reflect on what went wrong and improve the process for next time. It completely transforms investing from this emotional gamble into a process of continuous learning and getting better.
So the ultimate takeaway here is this. Successful investing isn't about finding one hot stock. It's about building a system. These 5 rules, know your business, find a moat, bet on leaders, pay the right price, and above all, don't lose money, they're not just a list of tips. They're an interconnected checklist. And by using them together, you shift your entire mindset away from chasing short-term gains and building a financial house of cards to patiently laying a durable, solid foundation for long-term wealth. And that, my friends, is the difference between gambling and investing.